September 15th, 2008. As the first rays of sunlight struck New York's glass towers, a scene was unfolding in the heart of Manhattan that would be talked about for years. A 158-year-old institution, Lehman Brothers, an investment bank that had survived 2 world wars, the Great Depression, and countless financial crises, was officially becoming history that morning. Dozens of cameras had gathered outside the building. Employees walked out carrying cardboard boxes filled with their personal belongings from their desks, stunned and silent as they stepped onto the street. Not everyone fully understood what had happened that day, but one thing was clear. A debt burden of approximately $613 billion had brought down one of the world's most respected financial institutions overnight. It was one of the largest bankruptcies in modern financial history. But what the cameras captured that morning was, in reality, only the final scene of a much older story. Because according to many historians and economists, the forces that led to Lehman's collapse can be traced back 101 years to 1907 to an ambitious move made by an ordinary-looking speculator, and some of the structural habits that began accumulating during that period still seem to exist in a corner of today's financial system. Right now, you may believe that the money in your wallet, your bank account, or your retirement fund is safe, and it most likely is. But within part of the global financial system, there is a structure that no single government can fully monitor and that most ordinary people are barely familiar with. A network that analysts call the shadow banking system, with an estimated size measured in the trillions of dollars. In this video, we will try to explain where this system came from and why it is still being debated today by following the trail of 2 major historical financial crises. Our story begins on a cold morning in October 1907. New York, October 1907. On the rain-soaked sidewalks of Wall Street, a man is walking briskly with a newspaper in his hand. Augustus Heinze. He comes from a wealthy copper mining family, is known for his extraordinary confidence, and together with his brother Otto is about to embark on one of the riskiest gambles in financial history. On paper, the plan was relatively simple. They would quietly accumulate a large portion of the outstanding shares of a copper company called United Copper, buying them little by little. Once they owned enough shares, they hoped to corner the investors who had sold the stock short. In other words, those betting that the price would fall. When those investors were forced to return the shares they had borrowed, they would be unable to find them on the market and would have no choice but to buy them at the inflated price set by the Heinze brothers. In the financial world, this maneuver was known as a corner. Had it succeeded, the brothers could have made an enormous profit in a very short time. But there was one thing they had failed to take into account. There are usually players in the market who are bigger and more level-headed than you are. Several financiers on the other side unexpectedly flooded the market with the shares they were holding. The structure the Heinze brothers had built began to shake within hours. United Copper's stock price fell rapidly, and the brothers' operation collapsed shortly afterward. The real crisis began when the connection behind this risky operation came to light. One of the institutions that had financed the Heinze's maneuver was Knickerbocker Trust, considered the 3rd largest financial institution in New York. As soon as newspapers reported that connection, perhaps the oldest instinct in the financial world took over. Once confidence is shaken, panic can spread rapidly. Rumours began circulating through the streets of New York within hours. The following morning, anxious depositors gathered outside the doors of Knickerbocker Trust. When the doors opened, they rushed inside. Everyone wanted the same thing, to get their own money back immediately. Cashiers kept paying out withdrawals for hours, but the line never seemed to end. By around noon, the bank's cash reserves had been largely depleted, and by the end of the day, Knickerbocker Trust was forced to close its doors. But the crisis did not remain confined to a single bank. The panic quickly spread to other trust companies, and then to parts of the traditional banking system. Perhaps the most striking fact of the time was this: the United States, despite being one of the world's largest economies, still did not have a central bank capable of stopping a crisis of this kind. There was no official mechanism to stabilize the system, and the financial structure was remarkably vulnerable to the risks created by its own size. How this crisis was eventually contained is not discussed very often, but it was an extraordinary intervention that has gone down in history. As the panic intensified, one of the most influential financiers of the era, J. Pierpont Morgan, invited the heads of the country's leading banks and trust companies to his private library on Madison Avenue. According to historical accounts, those who attended the meeting were exhausted and deeply anxious. None of them had a clear idea of what to do next. According to the story, once everyone had arrived, Morgan had the doors locked and told the participants they would not leave until they had agreed to create a joint fund to support the failing trust companies. Some details of this story may have been dramatised over time, but the central event, Morgan using his own capital and influence to bring the banks together, is supported by historical records. As a result, Morgan became known in financial circles as the man who prevented the system from collapsing in the short term by putting his own reputation and fortune on the line. This was not an action taken by a government institution, but by a single individual, and it sparked an important debate that would continue in the years to come. The Panic of 1907 is remembered as one of the clearest examples of how power and capital can become intertwined. A problem that no official institution could solve appeared to have been resolved by a single man, using his own resources in his own library. This deeply unsettled American politics at the time. The idea that a country's financial stability could depend on the initiative of one wealthy individual was unacceptable to many politicians. In 1912 and 1913, the Pujo Committee investigated the influence that major banks and financiers held over the financial markets. Its findings further strengthened public concerns about the concentration of financial power. As a result of these debates, in 1913 the US Congress established the Federal Reserve System, better known today as the Fed, so that future crises would no longer depend on the goodwill of private individuals. But did the creation of the Fed really mean that similar risks had disappeared? Let's move the story forward 101 years, back to the morning of September 15, 2008. To the very scene we began this video with. Nearly a century after the Federal Reserve was established, the global economy found itself facing a similar dynamic once again, but this time in a far more complex and far less visible form. The 2008 financial crisis is often associated only with the collapse of the housing market, specifically the subprime mortgage market. But according to many economists, that was only the visible side of the story. One of the factors believed to have played a significant role in the collapse of Lehman Brothers was what became known as the shadow banking system. Unlike traditional banks, Lehman was not built primarily on a model that relied on deposits from ordinary customers. Instead, it borrowed significant amounts of money through special-purpose entities that did not fully appear on its balance sheet, as well as through short-term repo markets. Some of the capital and liquidity rules that applied to traditional banks were not enforced on these structures with the same level of strictness. Mortgage-backed securities, whose value could change rapidly depending on market conditions, circulated between institutions as collateral, creating a complex chain of interconnected debt. When housing prices began to decline in 2008, that chain started to break. At the very moment when Lehman needed cash the most, it realized that the institutions lending to it had lost confidence. The ordinary depositors who had lined up outside Knickerbocker Trust in 1907 had been replaced in 2008 by institutional investors sitting behind trading screens and rapidly closing their positions. The mechanism was different, but the underlying dynamic was similar. Once confidence is shaken, highly leveraged systems can come under pressure very quickly. One of the most frequently cited moments on this subject came shortly after the crisis, when Alan Greenspan, who had led the Fed for many years, testified before Congress. Greenspan was widely known as one of the leading advocates of the view that markets largely regulate themselves. In October 2008, while responding to a question from Congressman Henry Waxman, he acknowledged that he had found a flaw in his own approach to assessing risk and described the crisis as an event of extraordinary magnitude. This is a verifiable statement recorded in the official congressional transcripts, and it is remarkable because one of the most prominent economic authorities of the time publicly acknowledged a limitation in his own model. Following Lehman's collapse, the uncertainty created by the interconnectedness of financial institutions led to a broad contraction in global credit markets. A financial problem in one region could quickly spread to institutions in another. After the 2008 financial crisis, many governments significantly tightened banking regulations. Capital requirements were increased, and certain high-risk activities were restricted. These measures are generally considered to have strengthened the resilience of the traditional banking system. However, some economists point to another development. As regulations became stricter, some financial activities may have shifted outside the banking system into less regulated areas. such as hedge funds, private equity firms, and private credit funds. That does not automatically mean these sectors are a sign of an impending crisis. Many experts also view this shift as a natural evolution of the financial system. Even so, the relatively low level of transparency in these areas makes it more difficult for regulators to accurately measure systemic risk. According to the periodic reports published by the Financial Stability Board, FSB, the global non-bank financial intermediation sector has grown substantially in recent years, and these figures continue to be updated over time. This means that an enormous volume of capital is operating outside the direct scope of traditional banking supervision. These funds generally serve institutional investors and high net worth individuals rather than the broader public. As a result, they rarely receive the same level of attention in everyday news as an ordinary savings account. That does not mean the system is automatically fragile. Rather, it is an area that deserves close attention because of its size and interconnectedness. Institutions such as the International Monetary Fund, IMF, and the Financial Stability Board, FSB, have been monitoring this sector more closely in recent years, highlighting potential risks in their reports. So the issue is not that no one is aware of this part of the financial system, but that the regulatory tools available may not be as developed as those used for traditional banking. One of the most widely discussed characteristics of these structures is the use of leverage. Some funds are able to take positions far larger than their own capital by using swap agreements and derivative instruments. When markets move in their favour, this can amplify returns, but in the opposite scenario, losses can grow just as quickly. Many market analyses also point out that higher interest rates are placing additional pressure on debt-dependent structures. Today's financial system, unlike those of 1907 or 2008, also includes high-frequency algorithmic trading and automated risk management systems. This means that, in some scenarios, price movements can occur much more rapidly. At the same time, it should also be noted that regulators and market participants now have far more data and monitoring tools than they did in the past. In other words, speed is a double-edged factor. It has the potential to amplify both risks and opportunities for early intervention. In 1907, what temporarily stabilized the system was a decision made by one banker inside his private library. In 2008, it was the coordinated intervention of governments and central banks that proved decisive. Today, the size of what is known as the shadow banking system remains an important focus for financial regulators. This should not necessarily be interpreted as a sign that another crisis is inevitable. Rather, it can be seen as an indication that as the financial system becomes more complex, new methods of oversight become increasingly necessary. Perhaps the real question is this: how effective would the mechanisms that helped contain past crises, a powerful individual or coordinated government intervention, be in today's far more fragmented and global financial system? This is not investment advice. For decisions regarding your own portfolio, you should consult a licensed financial advisor. The purpose of this video is to provide a general overview of recurring historical patterns that have appeared in financial history from time to time. What appeared to be a relatively small gamble involving a copper stock triggered a widespread financial panic in 1907. More than a century later, on a much larger and more complex scale, some of the same underlying dynamics, confidence, leverage, and interconnectedness, remain part of today's financial system. If you enjoy in-depth analyses of lesser-known moments in financial history and the structure of today's financial system, be sure to like this video and subscribe to the channel. What do you think is the most effective way to reduce systemic financial risk? Let me know your thoughts in the comments.